Hey everyone, welcome back to Corporate Decoder. Today, we're diving into a report from Cinemark, the movie theater chain. Get ready for some drama behind the screens because this isn't just about popcorn and ticket sales, it's about how they're planning to buy back a bunch of their own stock. What does that mean for you and for the company? Let's find out. Alright, so Cinemark's board gave the thumbs up to a share repurchase program. Basically, they're planning to buy back up to $200 million of their own stock. Think of it like this. The company is saying we believe in ourselves so much that we're willing to invest in our own shares. They can do this in a bunch of ways, like buying shares on the open market or through private deals. They could even use something called a Rule 10b 5-to-1 trading plan, which is a prearranged plan that lets them buy shares even when they normally couldn't, like during periods when insiders aren't allowed to trade because they know important information. This plan kicks off on March 11, 2025, and will last until they've spent all $200 million, or until the board decides to stop or change it. So the company can change the program depending on how it feels about the current state of business. The actual timing and amount of these repurchases are up to the Cinemark's management, and it depends on things like the market, the price of their stock, and other factors they deem important. They're not locked into buying a certain amount at a certain time. In other words, it's opportunistic. Where's the money coming from? Their available cash. They aren't borrowing the money, they're using cash on hand. That cash could also be used for investments to grow the business, so the company clearly thinks that shares are a great investment. Now here's where it gets a bit more interesting. Cinemark says they're doing this to take advantage of chances to buy back their stock and to deal with something called potential dilution related to their convertible notes, which are like bonds that can be turned into stock, and a related call spread, which is a hedging strategy. These notes mature in August 2025. Basically, they're trying to manage their stock price and avoid having too many new shares flood the market when these notes get converted. Cinemark also believes that this buyback program is good for its shareholders and shows they're confident in their long-term business future. It's a sign that they believe in their company and its future performance. Cinemark stock is listed on the New York Stock Exchange under the ticker symbol CNK. So if you want to track how this buyback program affects the stock price, that's the ticker to watch. Now, a quick word on forward-looking statements. The company says, and this is standard, that these plans are subject to change based on all sorts of factors, and they're not promising to update us every step of the way. So keep in mind that things could change. They can't predict the future, and the future can change. So what does this all mean? It's a mixed bag. On one hand, a stock buyback can boost the stock price because it reduces the number of shares outstanding, which can increase earnings per share. It also signals that the company thinks its stock is undervalued, and it shows confidence to the markets. On the other hand, it's using $200 million in cash that could be used for other things, like paying down debt, investing in new theaters, improving existing ones, or making acquisitions. The company is effectively betting on itself instead of growing. It's possible this also means the company doesn't see better investment options at the moment. Also, the mention of convertible notes and call spreads adds another layer of complexity. It suggests that Cinemark is trying to manage its capital structure and avoid potential dilution. It's important to remember that the movie theater industry has faced big challenges in recent years with the rise of streaming services and the pandemic. While things have improved, the industry is still evolving. Cinemark is a big player in the movie theater market, with a lot of theaters in the United States and Latin America. They've been working on improving the movie-going experience with things like luxury seating, enhanced food and beverage options, and premium formats like IMAX and XD. These efforts have helped them compete with the convenience of streaming at home. So, looking at Cinemark's situation, they are trying to reward shareholders and increase their share price using cash. That cash, however, could be used to expand and grow the company. The company is betting on itself, and it's an interesting strategy. Ultimately, whether this stock buyback program is a good move for Cinemark will depend on how well they execute it, the overall health of the movie theater industry, and their ability to adapt to changing consumer preferences. Keep an eye on Cinemark. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives. Let me know in the comments what company you'd like us to decode next.